Today, we will talk about long-term debt. Long-term debt is debt that matures in more than 1 year. This can be from the perspective of financial statement reporting by the issuer or from an investing standpoint. For companies, it means they have to record long-term debt issuance and all associated payment obligations on their financial statements. On the other hand, for investing, it involves putting money into debt investments with maturities of more than 1 year. Long-term debt is debt that matures in more than 1 year. Companies issue long-term debt with various considerations, focusing on the timeframe for repayment and interest to be paid. Investors are attracted to long-term debt for the benefits of interest payments and consider the maturity time a liquidity risk. The valuations and obligations of long-term debt are heavily dependent on market rate changes and whether or not the interest terms are fixed or floating. Companies take on long-term debt to obtain immediate capital. This debt can be used to pay for startup costs or fund regular and new capital expenditures for mature businesses. Longer-term debt usually requires a slightly higher interest rate than shorter-term debt, but having a longer time to repay the principal with interest is advantageous for companies. A company can utilize various debt instruments to raise capital, such as credit lines, bank loans, and bonds with obligations and maturities greater than 1 year. The portion of debt due within a year is considered a short-term liability, while the remainder is a long-term liability. Companies use amortization schedules to account for each of the debt instrument obligations they must repay over time with interest. When a company pays back long-term debt, some obligations will be due within 1 year and some will be due in more than a year. Interest payments on debt affect a company's bottom-line net income and are reported on the income statement. Debt expense efficiency is analyzed using solvency ratios and comparing gross, operating, and net profit margins. High solvency ratios can indicate that a company is funding too much of its business with debt, posing cash flow or insolvency risks. Investors consider long-term debt as debt that matures in more than 1 year. They can choose from various long-term investments, such as U.S. Treasuries, municipal bonds, and corporate bonds. U.S. Treasuries have maturities ranging from 2 to 30 years, while municipal bonds fund infrastructure projects and corporate bonds have varying default risks. Here are 3 key takeaways. 1. Long-term debt is debt that matures in more than 1 year and is often treated differently from short-term debt. 2. For an issuer, long-term debt is a liability that must be repaid while owners of debt account for them as assets. 3. Long-term debt liabilities are a key component of business solvency ratios, which are analyzed by stakeholders and rating agencies when assessing solvency risk. Hope this would help. Thanks for watching.